Alrighty guys, I wasn't going to make a video today, but how can you not, right? So we saw 100 basis points, a full 1% interest rate hike from the Bank of Canada today, shocking me and pretty much everyone else in the industry who was expecting a 75 basis point hike. So let's talk about what this means for the market, what this might mean for the future. So here you have it. You got the headline here, Bank of Canada hikes rate to 2.5%, what it means for you. Let's hop over to trading economics here and look at the interest rate in Canada, the Bank of Canada interest rate. Over history. So here is I believe this is a 5-year chart. You can see here just a catastrophic rise in interest rates. You look at the 10-year, you go, wow, we're still above 10-year average. Now you go to the 25-year chart and you get some historical context here and you realize that these interest rates actually aren't that high. Now the difference with housing prices 20 years ago is not something I should have to explain. They were far lower. Relative to income, they were lower. Gross price was lower. And so interest rate hikes in this environment are going to have far more catastrophic effects, especially when you talk about certain markets like Oshawa, Durham, Whitby, York region, Barrie, Innisfil, Hamilton, these areas that have gone up 60 to 80% in the last 2 years on the basis, not on fundamentals, but rather on the availability of credit and the cost associated, so the interest rate attached to that credit. I've pulled up the graph for the average or the median selling price for a detached home in Oshawa. So this is the price of a detached home, median price of a detached home in Durham, right? You can see the meteoric rise through COVID, and you can see that in February, it pivoted, prices rolled over, and that was the absolute peak of the market. So February 2022, you were looking at a $1.162 million median sales price. Today, as of July to date, so the first 2 weeks of July here, looking at $780,000. So more than a 30% decline from the peak. What's really interesting about this chart to me is that you compare July of 2022 at $780 versus July of 2021 at $825,000. And you go, wow, Oshawa is showing a year-over-year decline. So some markets, some neighborhoods are actually showing year-over-year price regression here. And it is getting ugly out there. It is getting so ugly that some people are throwing up GoFundMes to help them fund their down payment, because if they walk away from their purchase, they will of course get sued for the difference in selling price versus what they paid and the next buyer will pay, right? So obviously not fun to laugh at people's pain. A lot of people are going to get hurt in this. And it's not just going to be people who recently purchased in the last 6 months. It's also going to be people who are coming up for mortgage renewal. And frankly, not everybody follows me on YouTube or follows the news, right? And so not everybody's even really aware of I know it sounds crazy to people who are watching YouTube videos about the housing market, but truth be told, I talk to people all the time who don't understand how their variable rate mortgage works, have no ideas that these interest rate hikes are happening. And so it's going to be a shock. It's going to be a real sticker shock for some people who are going in to renew their mortgage soon. Now, this is a chart I found on Twitter from Brendan Bernard, and this is something I've talked about before, that if your home prices decline relative to your interest rates increasing and the payment attached to that increasing, the home affordability doesn't actually get any better. Right. So here we have in July of 2021, you buy $1 million home with 20% down, so $200,000 down payment at 1.68%, amortized over 25 years. Your annual payment would be $39,211. Now, if you purchase that same home today in July of 2022 with a 19% price decline at $810,000 instead of $1 million, but you had the same down payment of $200,000 at today's interest rate at 4.14. You would have the exact same yearly annual payment, right? So your actual affordability on that home, if it went down 19% since July of 2021, it didn't get any better. The affordability didn't change, right? And this is something that's important to keep in mind. And this reminds me of what the Bank of Canada Governor Tiff Macklem said in July of 2020. He said, if you've got a mortgage, if you're considering making a purchase or your business and you're going to make an investment, you can be confident that rates will be low for a long time. Now, this doesn't absolve anyone of responsibility. Obviously, you make a home purchase, you are betting on the future. If you choose a variable over a 5-year fixed, again, you are betting that that's going to play out in your favor. But at the end of the day, nobody can deny that this is incredibly atrocious forward guidance that, of course, made a lot of people feel confident purchasing homes that they maybe wouldn't have been able to afford with higher interest rates. And it's going to bite a lot of people. Now, it's worth looking at mortgage debt in Canada here, because it's worth understanding that this isn't going to affect just exclusively people who purchased in the last year or two. This is going to affect other people as well when it comes up for renewal, right? So if you look at home ownership rates in Canada, about 68%. So you've got 5 million homes renting here. You have an additional 3.6 million homes that are paid off, so no mortgage debt at all. You have 290,000 homes that are paid off but have HELOC. Doesn't mean they're utilizing that debt, but they have that home equity line of credit available to them. And then this is where the risk is baked in. So you have 4.36 million homes owned with a mortgage, with debt. That has to be renewed at higher rates, obviously. And then you have 1.72 million homes with a mortgage and HELOC. So some carnage here. You've got this home in Brampton. All right, this one sold in February for 1.525 million. That buyer would have failed to close on this purchase. The appraisal didn't come in, right? Couldn't get the financing. And it just resold for $1.2 million last month. So, the original buyer is going to get sued for the difference in price. And of course, he's going to lose his deposit. So again, not a great time to be a recent home buyer. Here we have one in Hamilton that sold in May for $800,000 and it just resold for $620,000, right? So this one's interesting because, May wasn't the top of the market. February was. And so you're even seeing declines on just really a 2-month spread on this particular listing in Hamilton. So the reason we're seeing rate hikes is because Bank of Canada and the Federal Reserve in the US have to get inflation under control, right? They have a dual mandate. Number one is to manage inflation, and number two is they have a mandate regarding employment. They want to watch jobs as well. Now, the job numbers in Canada just came out, and while the total number of jobs actually decreased, the amount of people looking for jobs decreased as well, and so unemployment rate decreased. So you're not going to see the narrative pivot to rate cuts just yet because the employment market is very strong, and inflation continues to grow. So this is a U.S. inflation number, but Canada's will, of course, be somewhat similar. So the U.S. inflation number posted 9.1%, which is higher than expectations. And I think it's worth drilling down and looking at what really moved the needle in June in particular. And you can see here gas, utility gas, and of course electricity were leading the pack in terms of what caused that rapid rise. Now it is worth noting that in July some of these costs are down marginally, and so July's inflation numbers might actually look a little bit better, but they're still going to be very elevated. And we are in a technical balanced market. So if you look at months of inventory in the condo market, we're at 3.36. So anything below 3 is a seller's market, 3 to 5 is a balanced market, and 5+ is a buyer's market. And freehold's sitting just shy of 3 months of inventory as well. Now, what's interesting is listing terminations are outpacing actual sales. And so if you were to control for terminations, it is likely that these months of inventory numbers would actually be in the buyer's market category. And that's why you're seeing prices fall, and you're seeing them fall so rapidly. The one silver lining is that rent prices are, of course, rising, and they're rising quickly, right? So if you look at Vancouver, rental rates are up 20%. Toronto rental rates are up 15.7%. So I looked at the median rental price for a 1-bedroom condo with my own data and found that the pre-COVID peak for a 1-bedroom, the median 1-bedroom rental in the 416 was $2,300 a month. Today it's sitting at $2,400 a month. So yeah, these numbers look really good on paper, but of course, we saw rent prices in Toronto and in Vancouver decline through COVID. We've now recovered for that, and rental prices are higher than ever, but it's worth noting that it's not 15% from peak. It's 15% from last year's numbers, which were a little bit lower than the pre-COVID peak. Rental rates will probably continue to rise, right? They tend to in a rising interest rate environment. And in addition to that, you're starting to see people return to the office, right? So you can see here that office occupancy in downtown Toronto continues to climb. Of course, we're still very low from historical norms, still sitting at 27% occupancy, but it's trending in the right direction. It's trending in the direction we want to see. And then, of course, when you look at the Federal Reserve, and I use numbers from the US simply because at the end of the day, Bank of Canada for more or less follows what the US does. When you look at the implied Fed rate move in 2023, you can see that up until early this year, the market was assuming that we were going to see 50 basis points of rate hikes in 2023 above and beyond whatever they do for rates in 2022. What we are now seeing, and a shift that has happened kind of rapidly, is the market is now implying that we are going to see 75 basis points of rate cuts in 2023. So the market is basically saying something's going to roll over. Either inflation is going to start coming back down or unemployment is going to start to rise. In either instance, that will change the narrative from more rate hikes into, stop either pausing rate hikes or looking at rate cuts. So who knows when that'll happen, but I do not think that home prices in the GTA, I don't think that things are going to get better until you see rates either normalize or decrease. So that is my take. As far as when that actually happens, who really knows? But I don't think you're going to see any relief in the market until it does. And of course, the silver lining, as always, if you watch my other videos, and I'll link one in the comments or in the description below, is that we are seeing housing supply contract. We are seeing condo projects cancel. We are seeing purpose-built rental projects get shelved by developers because the numbers no longer pencil with the new cost of construction and the new and all of the new policies that Toronto is rolling out. And so you're seeing housing supply contract in real time, particularly in Toronto, at the same time as our immigration targets are moving up. And so as far as I'm concerned, I'm still very bullish on the long-term outlook of the Toronto housing market. But like I said, things are not going to get better in the short term. They're likely going to get a little bit worse. So that's it for today, guys. If you like this type of content, please like and subscribe, and I'll see you guys next week.